So you bought a pre-construction property and the closing is quickly approaching. A lot of people ask me, what are my options here? Well, if you purchase a pre-construction property and your closing date is just around the corner, you might feel pressure, especially if your life situations have changed, the market isn't cooperating, or your original plans for the unit, say you plan to live in it or bought it as a rental, those might have changed since you bought the property. So here are the most common options available to you when your closing date is approaching. The first one is an assignment sale. An assignment means selling your contract to another buyer before closing. While the strategy is common in markets like Toronto and Vancouver, Calgary's assignment market is virtually non-existent. In fact, prior to 2021, pre-construction was not even a thing in Calgary. Developers would build the building first, then sell units afterwards. So buyers took immediate possession, and assignments were virtually unheard of and are still relatively rare. And making it even more challenging, developers don't allow you to advertise on any public-facing websites like MLS, Realtor.ca, Facebook. It makes it nearly impossible to find a buyer. So realistically, if you want to assign your unit in Calgary today, you're going to need to offer a very large discount, likely 15 to 20% below your purchase price, plus your selling costs. For most sellers, this is simply not an attractive or viable option. So option number 2, giving the unit back. Many buyers wonder, can I just give the unit back and walk away? The short answer is no. Developers never agree to simply take the unit back and return your deposit. While rare cases exist where mutual releases have been granted when a deposit was forfeited, they're definitely the exception and absolutely not the rule. When a developer agrees to a mutual release, they give up their legal right to sue you for damages later, and most simply just will not do that. So that brings you to option number 3, which is defaulting on your purchase. Defaulting means failing to close on your contract at the date and time specified. And in this case, the developer has the legal right to retain your deposit and resell the unit. If they sell the unit for less than the amount in your contract, including their legal, financing, and selling costs, they can sue you for the shortfall, for the difference. While in Calgary, I haven't seen many cases of this play out yet, developers in other markets are definitely suing buyers who have defaulted when it's in their financial interest. This is not a risk-free way to get out of your purchase and should be treated only as a last resort. Please get professional legal advice if you are considering this option. So that brings us to option number 4. You can close on the property and then immediately sell it if you don't want to keep it. If you can come up with the funds to close, another option is to take possession of the unit and then list it for sale right away. To make this strategy work, considering getting a variable rate or completely open mortgage that you can repay at any time. This will allow you to sell without incurring significant penalties from the bank or financial company. It's also critical to opt out of any rental guarantee program before closing so that you can deliver vacant possession of the unit to the new buyer. Because a tenanted unit is much, much harder to sell, and I guarantee it will sell for less than a vacant property. There are also tax implications here as well if you sell it right away, mainly that any profit is going to be considered as income and added onto your marginal tax rate for that year. If you have a profit, this could mean tens of thousands of dollars in extra taxes that you're paying. Alternatively, if you have a loss, you may not be able to write this off against your other investments. So again, please get professional accounting advice if you are considering this option. And number 5, and definitely my preferred method, close on the property and hold for the long term. This is the strategy that I recommend for everyone that can financially manage it, qualify for a mortgage, in order to maximize the return on their investment, because you make money in real estate over the long term. By holding your property for at least 1 year, any profit you make from the sale is going to be treated as a capital gain rather than income. This means you pay 50% less tax on it. And on top of that, if you rent out the unit for at least a year, you should be able to qualify for the GST rebate of up to $6,300 as well, which is essentially free money back in your pocket. Holding that property also gives the market time to stabilize, because immediately after closing, there's going to be a flood of new listings as other buyers and people try to exit their purchases for many different reasons. And this can temporarily suppress prices. By waiting out this initial supply shock, you give your property a chance to appreciate in value. And most importantly, real estate is a long-term wealth building tool. When you hold, you benefit from passive equity growth, mortgage paydown, cash flow, and the potential for very strong long-term returns. It's the strategy that is the most stable and tax-efficient option and nearly always produces the highest returns. Now, every situation is different, and the wrong decision can be costly. So understanding your options ahead of closing can help you make the best decision, whether that means weathering the short-term turbulence or adjusting course and selling. If your closing is coming up and you're unsure what to do, don't navigate this alone. I help clients across Canada make strategic choices about their pre-construction properties, especially in markets like Calgary and Toronto. So if you need help, let's chat and see how we can make your investment work for you. Please book a call with me today. There's no obligation and it's 100% free. You have nothing to lose.